Yes, sir. Good evening.
All right. Our class will continue from where we stopped last week. Last week we discussed theory of constraints and throughput accounting. We explained that theory of constraints. I'm trying to do a recap of our last class. We explained that the theory of constraints is a theory that explains how company can maximize profit. When a company is faced with bottleneck, a bottleneck resource. What is bottleneck resource? Resource that limit a company from making more profits. Bottleneck resource is a limiting factor. The bottleneck resource may be production capacity or production hours. And we said all companies, regardless of your size or your nature of business, something we always act as a bottleneck. Responsibility of managers is to find a way to maximize profit subject to bottleneck resource. We explained this. We now look at the concept of throughput accounting. And we said this concept, throughput accounting, is a production method or approach to production. An approach to production that is usually used. An approach to production that has been developed from the theory of constraints. As an alternative for cost and management accounting in a just-in-time production environment. Throughput accounting is an accounting method that focuses on maximization of throughput. Throughput is calculated as your selling price less material cost. This accounting method assumes that material cost is the only variable cost. All other costs are assumed to be fixed. Our throughput accounting concept can be used for performance measurements. We can use this to measure the profitability performance of individual products. That will tell us which of our products is the most profitable, so that we can focus on that product that is generating the highest profits. We explain this. We explain how to calculate throughput accounting ratio, which is calculated as return per factory hour divided by cost per factory hour. And we say this ratio should be greater than 1. For a product to be profitable, the throughput accounting ratio must be greater than 1. If the ratio is less than 1, that means that product is not profitable. And management must identify ways to improve the product profitability. Alternatively, management can decide to discontinue the product. We explain this. We also explain that throughput can be used for decision making. You can use throughput to decide optimal product mix. The optimal product mix, that production mix that will maximize profit for the company. Where a company is faced with a single bottleneck, a single limiting factor, a single constraint, we explained this. At the last class, we solved question number 1. Our last class, we solved question 1. That was the question on page 133. Solar system and co. Tonight, by God's grace, we shall look at question 2. I'm not sure we have started this question. Now refer to page 134 of your study pack. Page 4 of your study pack or your study kit. Let us look at illustration 2. PK Limited. We are waiting. Now, please, if you are solving this question, please get your book and write in class. Why am I saying this? For those that were in class last week, of course, you cannot predict IT system. There was truncation on some of the things that we have done. So please, I'll repeat it. Get your book, get your pen, and try to write in the classroom. Whatever happens will not affect you. Although we are still going to share the solution. All right. Can we go ahead with the class? Kayode, can we go ahead?
Yes, sir.
All right, Voto. Chairman, please don't touch my screen. Once you touch my screen, you are going to make a mark.
Good evening, sir.
Yeah, Voto. Let me expand this. Okay, 125 should be okay. All right. We move to this. PK Limited manufacture 2 models of heavy duty cooking rack suitable for use in restaurant kitchens and similar commercial environments. Both models use the same type of raw material and machine hour. No inventories ahead. The sales budget for next year is as follows. Our budget, Model A and Model B, sales in units. For Model A, 300,000. For Model B, 140,000. Selling price for Model A, 1,000. For Model B, 1,400. Cost data. Material cost, 400 naira. For Model A, 500 naira for Model B. Variable production conversion cost, 100 naira for Model A, 300 naira for Model B. Next, fixed production overhead attributable to the manufacture of the two models amount to 40,500,000. Each model is completed in the machining department. The production rate per hour in that department is Model A, 12.5 units to be produced per hour. For Model B, 10 units to be produced per hour. Availability of machine hour is limited to 30,000 hours. Requirements A. Using marginal costing principle, calculate the mix, in bracket units, of each model, which will maximize net profits and indicate the value of the net profit. Right. Now, to that requirement, examiner says calculate the mix of each model, meaning how many units of Model A and unit of Model B that we need to produce if we are to maximize profit. For examiner to say calculate the mix of each model that will maximize profit, it means we don't have sufficient resources to meet all the production. Say demand for Model A, 300,000. Say demand for Model B, 140,000. For the examiner to ask you to calculate a mix that will maximize profit, that means there is a limiting factor. That means there is a bottleneck. Otherwise, we are supposed to produce all the customers' demand. If there is no limitation, we should meet all the demand 100%. Unlike the first question we solved, examiner informed us that a particular machine was the bottleneck. For this particular question, examiner didn't tell us the bottleneck. But we know that production happens in machine department. We need to calculate. We need to identify the bottleneck. The first working is that I want to know which of these company resources is in limitation, is not sufficient. Secondly, marginal costing principles. What is marginal costing principles? These principles, we calculate contribution by considering all the variable costs. Unlike throughput accounting principles, marginal costing principle, contribution is calculated as selling price minus all the variable costs. Now let's go to this solution. To requirements 1, calculation of machine hour per unit. I want to know what is the machine hour required to produce 1 unit. For model A, please get your pen. Examiner says model A, 12.5 units produce in 1 hour. 12.5 units is produced per hour. What is the hour required to produce 1 unit? Look at it. Hours required to produce 1 unit of model A is equal to 1 divided by 12.5 units. Please work this out. 0.08 per unit. That is the hour required to produce. Examiner says 10 units. Examiner says 10 units produce in hours required to produce 1 unit. Let me take this down. Hours required to produce 1 unit of model B hours required to produce 1 unit of model B is equal to 1/10 units, 0.1 hour per unit. We have gotten the hours required per unit. Now, calculation of total machine hour required to meet maximum demand. I want to know, what is the total machine hour if I'm to meet all my customer demand? 6 units for model B, model A, 300,000. Please look at the question. For model B, 400,000. And to produce 1 unit of model A in machine department, we require 0.08 hours. Total hours for model A, if you multiply, 24,000 hours. For model B, the sales unit is 140,000 units. To produce 1 unit of model B, 0.1 hour. Total hour required. For model B, 14,000 hours. To meet all the customers' demand, both model A and B, total machine hour required. No, it's hour. 38,000 machine hour. Total machine hour required. $38,000. Examiner says machine hour available is limited to 30,000 hours. That means machine hour available is not sufficient to meet all the sales volume. Yes, there's a bottleneck. Yes, there's bottleneck. The bottleneck resource is machine hour. Is machine hours. So, and I want to use marginal costing principle to calculate this mix, or the mix unit of each model to be produced if I'm to maximize profit. Because I cannot meet all the customers' demand. And I want to use marginal costing principle to determine the optimal product mix. That product mix that will maximize company's profit. You are going to calculate contribution per unit. First, selling price for model A, ₦1,000. For model B, ₦1,400. Now pick your variable cost. Variable cost, material cost for model A, ₦400. Model B, ₦500. Variable production conversion cost. Conversion cost. For model A, ₦100. Model B, ₦300. Cost in brackets. Now get contribution per unit. 1,000 naira minus 400 minus 100. This will give us 500 naira. $1,004 minus 500 minus 300. That will give us 600 naira. You have gotten contribution per unit. Now introduce the bottleneck resource. What is the machine hour required to produce 1 unit of model A? That is 0.08. Machine hour here. 0.08 hour. 0.1 year. Now calculate contribution per unit of machine hour. That is contribution per unit of the bottleneck resource. 500 divided by 0.08 hour. This will give you 6,250. 600 divided by 0.1 hour. That will give you 6,000. You have gotten contribution per unit of bottleneck. Next, do your ranking. This will rank first. This ranks second. Meaning that we are going to produce model A first. Until we finish model A, we now go to model B. Now go to your table of allocation so as to determine optimum product mix. Maximum machine hour, 30,000 hours. Ranking first, model A. Sales units for model A, 300,000. And to produce 1 unit of model A, 0.08 hours of machine. That means you require 24,000 hours of machine for model A. Out of 30,000, 24,000 will be dedicated to Model A production. You are left with 16,000 hours. This balance will be dedicated to Model B. Model B. Now go back small.
Sir, the hours remaining is 6,000.
Oh, thank you. Oh, that's true. Look at Model A. To meet maximum demand, we require 14,000 hours. And the hours remaining here is just 6,000. Thank you. To meet the total sales for Model A, we require 14,000 hours of machine. But we are only left with 6,000 hours. That means we cannot meet 100% production for Model B. How many can we do with 6,000 hours? To produce 1 unit of Model B, you require 0.1 hours. To produce 1 unit of Model B, we require 0.1 hour. If I have 6,000 hours, how many Model B can I do? Yes?
That will be doing like 60,000 hours, sir.
Thank you. You do a work back. Look at it. I have 6,000 hours remaining. To produce 1 Model B, I require 0.1 hour. I can do 60,000 units. Now return here. I can only do 60,000 units of Model B at a rate of 0.1 hour. This is just working. Then 6 hours remaining dedicated to Model B. At the end of the day, no more hours. Nil. So your optimal production mix, that production mix that will maximize profits using marginal costing principle is equal to Model A we have to do 300,000 units. Model B, we can only do 60,000 units. That is the optimal net profit. You now introduce contribution. Contribution per unit for Model A, 500 naira. Contribution per unit for Model B, 600 naira. $300,000 multiplied by 500,000. What do we have?
150 million.
150 million.
So Michael.
60,000 multiplied by 600. What do we have?
36 million.
36 million.
36 million. I'm trying to save, okay? 36 million. Total contribution from the two products. 186 million. Less your fees overhead. If you go back to the question, fees production overhead, 40,500. Less 40,500,000. What is the maximum profit? Please
145.
calculate.
500.
145
500.
million 500,000. You are done with requirement A. You are done with requirement A. You now go to, if there's no question, we move to requirement B. If there's no question, we move to requirement B. All right, look at requirement B. You can read it. I'll be back. I'll be back in 1 minute. You can go to the requirement B. I'll be back in a minute.
Can you scroll down, sir, before you?
Okay, what do you want?
I want to see the solution.
Where should I stop?
It's okay. It's okay now. Yes, sir. Thank you, sir.
Yeah, B.
Yes, sir.
I should go small.
Go up small, sir. It's okay, sir.
All right. I'll be back. Let me quickly run through this. All right, let's go on with the class. I hope you are done copying.
Yes, sir.
Requirement B. The question says, calculate the throughput accounting ratio model and briefly discuss when it is worth producing, where throughput accounting principles are in operation. Your answer should assume that the variable cost amounting to 24 million incurred as a result of the choosing product mix in part A is fixed in the short run. Now the question is, calculate throughput accounting ratio. If you recall, look at it. Formula for the ratio. Return per factory hour divided by cost per factory hour. Where your return per factory hour is equal to throughput return divided by time taken in bottleneck resource. Your cost per factory hour, total factory cost divided by time taken, total time available in bottleneck resource. Let us move to this. To calculate my ratio, I'll pick my selling price, 1,000 naira, 1,400. I will pick material cost, 400, 500. Get return per unit. Throughput return per unit. 1,000 minus 400. This will give me 600 naira. Remember, under throughput, material cost is the only variable cost. 1,004 minus 500 naira. This is 900 naira. Introduce your bottleneck. Time taken in bottleneck. To produce 1 unit of model A, machine hour required 0.08 hour. For model B, 0.1 hour. Now calculate return per factory hour. Throughput return divided by time taken in bottleneck. 600 divided by 0.08. Please calculate. This will give you 7,500. 900 divided by 0.1. This will give you 9,000. This is Naira, 7,500 per bottleneck, per unit of factory hour. The factory hour is machine hour. You now do, okay? You have gotten, look at it. You have gotten return per factory hour. Next, cost per factory hour. Total factory cost divided by total time available in bottleneck resource. And remember, we said total factory cost. All production costs except material cost. Our total factory cost. All production costs excluding material cost. We pick fixed production overhead, 40,500,000. Variable production conversion cost. Examiners, they look at it. Examiner says your answer should assume that variable cost amounting to 24 million incurred as a result of the choosing product mix in A. What is the choosing production mix in A? Let's go to it. We have to show that working here. Ooh. Let's do it here. Products. Okay, let me come down small. Products mix in part A is model A. We are going to do 300,000. Model B, we are going to do 60,000. This is the choosing production mix in part A. Our variable production conversion cost per unit for model A multiplied by variable production conversion cost. For model A, 100 naira per unit. For model B, 300 naira per unit. Total variable production conversion cost. For model A, 30 million. For model B, total variable production conversion cost, 18 million. Based on the choosing mix. Total year, 48 million. Examiner says 24 million of this is fixed. That means the balance is variable. Return here. Variable production, conversion costs, fees in the short term, 24 million. Based on the choosing product mix, other variable production conversion costs. Out of 48 million, 24 is fees temporary. Balance is 24. Your total factory cost. All production costs excluding material costs. Your total factory cost. All the production costs incurred, whether variable, whether fixed, whatever cost, production, excluding material costs. That is the principle with throughput accounting. Sum up. This gives us 88 million. You have gotten your total factory cost.
88.5.
88,
Oh, forgive
500.
me. $500,000. You can now calculate your cost per factory hour. Total hours available in bottleneck. Examiner says machine hours is limited to 30,000 hours. Now return here. My cost per factory hour is equal to cost per factory hour is equal to 88,500,000 divided by 30,000 machine hour. Please calculate 2,950. You can reconfirm.
Correct, sir.
Correct.
You can now calculate your throughput accounting ratio. Return per factory hour divided by cost per factory hour. You can return here. This is 2,950, 2,950. Whether model A or model B, cost per factory hour is the same. Now divide. 7,500 divided by 2,950. 2.54.
Yes, sir.
9,000 divided by 2,950. 3.05. This is confirmed.
Correct.
You have gotten your throughput accounting ratio based on the choosing production mix in part A. When you are done calculating, examiner say explain when it is worth producing, when throughput accounting ratio is in operation. When can we produce goods? to comment on that. When is it worth producing? When throughput accounting ratio principle and operation. A product is worth producing if the ratio is greater than 1. Look at it. With throughputs, accounting principles. A product is only worth producing if the throughputs, accounting ratio is greater than 1. In that case, let's add more to it. If the ratio is greater than 1, then there should be down here, than 1. It means that the products generates more cash from sales than cost incurred. Trying to see. Okay. Than cost incurred. You are done with requirement B. If there's no question, we move to requirement C. Examiner says, using throughput accounting principles, advise management of the quantities of each model that should be manufactured, which will maximize profits, and prepare a projection of the net profits that will be earned by PK Limited next year. Again, you are asked. Examiner says calculate optimal production mix using throughput accounting principle. You have your products, pick your accounting ratio. This is 2.54. This is 3.05. Now do your ranking. Products, model B should come first. The ratio is higher, followed by model A. Now go to allocation table. Maximum machine hour, 30,000 hours. First ranking, model B. Model B maximum sales 140,000 units. And to produce one model B, 0.1 hours. Total hours required for model B, 14 hours. We are going to produce model B first. Out of 30,000 hours, 14,000 hours will be allocated to the production of model B. Remaining hours, 16,000 hours. We are left with 16,000 hours of machine. This balance will be dedicated to produce model A. For model A, maximum sales is 300,000 units. And to produce one model A, we require 0.08 hours. Total hours required for model A, 24,000 hours. And we are only left with 16,000 hours. That means we cannot do 100% of model A. How many model A can we produce? You have 16,000 hours. And to produce one A, if you take you 0.08 hours, how many model A can you produce? In that case, do like this.
200,000.
16,000 divided by 0.08. We can do 200,000 units at the rate of 0.08 hours. We can only do 200,000. Hours have been exhausted. This is nil. So our maximum, our optimal production mix, model A, we can do 200,000 units. Model B, we can do 140,000 units, 100%. That is the production mix that will maximize profit. Now, to get your net profit, pick return per factory hour. Sorry, return per unit. Return per unit here, 600. Per unit here, 900. Let me show you. return per unit, model A600 naira. That is selling price minus material cost. That is throughput return per unit. For model B, 900 naira. Get total return. $200,000 multiplied by 600. Total year, 120 million. 140,000 multiplied by 900. What is the total year?
126 million.
126 million. Total return for the two products, sum up.
246 million.
246 million. Then less total factory cost. 88,500,000. Maximum net profits. Maximum net profit. The difference.
$157,500,000.
Thank you. You are done with requirement C. The last requirement, if there's no question.
Hello, sir. I have a question.
Please go ahead.
Good evening, sir. Sir, please, where did you get the 140,000 when we are doing the ranking for model B? 140,000 times 0.1 hours. Where did you get that 140,000, sir?
Do you have the question with you?
Okay, sir.
So I also have
another. No, let us resolve this.
This unit.
Now look at the question.
This unit.
Sales unit for model A, 140. Model B, 300,000.
Okay, sir.
Your next question.
Okay, sir. For this throughput accounting side for the optimal product mix, the one we did before, we used we lessed the piece costs to get the maximum profit. So why are we lessing the total factory cost of 88,000 here on that throughput accounting method?
Okay. First is we made effort to explain the principle. If you have followed this class, last week we solved one question. We said under throughput, material cost is the only variable cost. All other costs are regarded as factory costs. All other costs are fixed costs. And they are called factory costs. Your factory costs include all production costs, excluding your material costs. That is the principle of throughput accounting. To calculate your net profit for throughputs, you are going to get your total return. Your return is selling price minus material cost. You now get throughput return. When you get throughput return, to get profit, less factory costs. Your factory costs include all production costs, excluding material costs. So for me to get my net profits, I must deduct the factory costs. If I'm dealing with throughput accounting, but if you are dealing with marginal costing, the principles are not the same. Marginal costing recognizes all variable costs, including material costs, labor costs, and other variable costs. That will now give you your contribution. When you get your contribution, your selling price minus all variable costs, that will give you your contribution. When you get your contribution, you now less it from your fixed cost so as to get your profit. That is marginal costing principle. I hope it's better.
Yes, sir. Thank you.
The last aspect of the question. Oh, I'm doing that. Thank God, though. Problem didn't come up today. Requirement D. Look at requirement D here. Explain two aspects in which the concept of contribution in throughput accounting differs from its use in marginal costing. Who can explain this? How is throughput accounting contribution different from marginal costing contribution?
Sir, under throughput accounting, we make use of our variable element is only the material cost. Whereas under marginal costing, we make use of all variable elements like direct material, direct expenses, direct labor.
Correct. That's answer number one. Then I say, give me two aspects. Number one has been explained. Look at it, please, on your screen. Throughput contribution is calculated as selling price less direct material cost. Why is marginal contribution is calculated as selling price less all variable costs? That is one aspect. Second aspect. Throughput accounting and marginal costing both determine contribution by calculating differences between sales revenue and variable cost. However, this contribution will be higher under throughput accounting. Contribution is higher under throughput accounting since only material costs are recognized as being variable costs. Under marginal costing, direct labor costs and certain overhead expenses will also be deducted from sales revenue in order to calculate contribution. This is because such costs are variable in nature. You can take one more. Throughput accounting regard such costs as fees. And this is true insofar they cannot be avoided. In marginal costing and throughput, the rate of contribution generated per unit of scarce resources can be used to determine optimal production mix. Let me take that again. In marginal costing and throughput accounting, the rate of contribution generated per unit of scarce resource, that is per bottleneck resource, can be used to determine the optimal production mix. However, different rankings can occur. If you go back, when we use marginal costing to calculate optimal product mix, model A is ranked first, followed by model B. When we use throughput accounting principle, model B is ranked first, followed by model A. However, different rankings can occur under each method, of which the decision maker must be aware. Oh, it can give different decision making. That's what we are trying to say. If you use marginal costing to make optimal product mix, we are going to get different optimal production mix. If you use throughput accounting ratio, the mix will be different. Decision maker need to be aware of this, of these differences. Is because of different principles. We are done with the question. Any question, please? All right. We have treated 2 questions, which is sufficient for this topic, but we are not leaving the class. We shall start next topic immediately. Our next topic is performance evaluation. Our next topic is divisional evaluation. What is this topic all about? Divisional performance evaluation. What is this topic all about? It's about evaluating the performance of different divisions within an organization. All right? I'm going to share that material now. Evaluating divisional performance. The material will be shared now. All right. Please check your screen and confirm you can see my new material. Please reconfirm you can see my screen.
Yes, sir.
Yes, sir.
We
All
can
right,
see your screen, sir.
What is this topic about? To appreciate this topic, now picture in your mind. Take your mind out of this classroom. Look at Dangote groups. Under Dangote, we have Dangote Cement, a division that specializes in cement manufacture and sales. We have Dangote Salt, a division that focuses on salt manufacture and sales. We have Dangote Sugar, a division whose core business is to manufacture and sell cement. We have Dangote Petroleum, we have Dangote Food, Dangote Flowers, Dangote Drinks. All the various divisions contribute to the total profit of Dangote. Now, how can we evaluate performance of individual divisions? That takes us to divisional performance evaluation. Our first discussion. What is divisionalization? Divisionalization involves the decentralization. To decentralize, decentralization of decision-making powers to division. Hence, division achieve some degree of independency. Divisions are given authority and power to make decisions. A divisional company is a company whose organization and operations are segmented into semi-autonomous units, each with a large degree of responsibility for decision making within respective units. For example, Dangote Cement, that divisional manager, the managing director of Dangote Cement, has been given the authority and power to make decisions about cement business. Dangote Salt, the manager in Dangote Salt has been given the power and authority to make decisions about salt business. The company is so big that the company is operated along divisional structure. Each division focuses on its core business. What are the objectives? What are the benefits of divisional structure? One, enhance goal congress. What does that mean? It means goal alignment. Every division must work towards the same objective. All divisions must work towards the objective of the company as a whole. There must be goal alignment. Number two, increase motivation of management by creating different divisions and giving managers authority and power. They are motivated. You are challenging your managers. It reduces head office bureaucracy. We don't need to depend on head office before we can make decisions. Divisional managers have been given the power and authority to make decisions. That reduces head office bureaucracy. Number next, provide better training grant for junior and middle level managers. By creating divisions, middle level managers can learn, they can grow. Lastly, improve strategic decision making. By creating divisions, allowing each division to focus on its core competence. Cement business, the manager focuses on cement. Salt business, the manager focuses on salt. There's improved strategic decision making. All right. Problems or disadvantages associated with divisional structure. What are the risks? What are the problems? One is suboptimality. A major problem of divisional structure or decentralization is the potential for dysfunctional decision making. There is high potential for dysfunctional decision making. That is, where divisions make decisions that are not in the best interest of the company as a whole. suboptimality. Divisions are taking decisions that are not good for the company as a whole. That decision may be good for a division, but from the viewpoint of company as a whole, that decision is not good. Number two, increased overhead costs. Where a company created divisional structure, where there is divisional structure, it will lead to duplication of common functions. That can easily lead to duplication of common functions. What are the common functions? HR functions, finance functions, admin functions. They are duplicated. If you look at Dangote now, Dangote Cement has its own HR. Dangote Salt has its own HR. Dangote Sugar has its own HR. Dangote Petroleum has its own HR. Common functions is duplicated. That will lead to increase in overhead cost. Number three problem, loss of control. Loss of control. By delegating authority and power to divisional managers to make decisions, head office may lose control. The corporate head office may not be aware of what is happening at the various divisions. These are the problems with divisional structure. These are the problems with divisional structure. How can we address this problem? How can we minimize this problem? This problem can be minimized. Please, 1 minute. Please, 1 minute. Try to charge my 1 minute. Let's go on with the class. All right. The problem highlighted above can be addressed by introducing a suitable performance measure. By introducing a CIS valuation, you can minimize the problem by introducing a suitable system of performance evaluation that have the following objective. The performance measure must be able to achieve the following objectives. What are the objectives? The performance measure should promote Go Congress. The performance measure should encourage initiative and motivation. The performance measure must provide feedbacks to management. Performance measure. It's not charging my phone. The performance measure should encourage long-term view rather than short-term view. So to minimize the problem of divisional structure, let's see. To minimize the problem, we must introduce the performance measure. Okay. The performance measure you are delegating powers, you are delegating authorities. Performance measure. Monitor the performance of the managers. Periodically, set a performance target and measurement. That performance measure must encourage managers to use their initiative. The performance measure must promote Go Congress, must provide feedbacks to management. measure should encourage long-term view. It's not about profits only. A company must for foreseeable future. And this objective explained may be achieved with the introduction of centers. These objectives, the objective of promoting Go Conference, encouraging initiative, we can only achieve this objective by introducing responsibility center. And there must be responsibility accounting. What is responsibility accounting? What responsibility center? Responsibility accounting. In a responsibility accounting, a particular manager is given a responsibility for of the budget. And within the budgetary control system, the manager is made accountable for actual performance. Responsibility is a situation where a specific manager, a particular aspect of, and that manager will be made accountable for that aspect of the budget. That manager is responsible for the actual performance of that budget. Let us illustrate. Look at equity professional. Two lecturers, Mr. Adejuwon and Mr. Shiwaju, have been given the responsibility to lecture performance management. From that performance management budget, certain percentage is allocated to Mr. Shiwaju. Each manager is made accountable for the actual performance of the assigned responsibility. Your syllabus is the budget. Some topics were assigned to Juwon. Some topics assigned to Shiwaju. Each individual, we are made accountable for our topics. After your class, if, for example, Juwon is supposed to treat linear programming with you. If examiner now asks question on linear programming, assuming number one question is linear programming, and Adejuwon didn't teach you, a student will now send message. Compulsory question number one, linear programming. We were not taught. As soon as we send that message, management will now ask, we are supposed to treat linear programming with the students. That part of the budget has been assigned to a particular manager. And the manager is made accountable for actual performance. In that case, they will now summon Adejuwon. Please come and explain. How come you didn't treat linear programming? This is your responsibility, and you are made accountable for it. That is responsibility accounting. The area of operations for which a manager is responsible a particular manager is responsible is called responsibility center. If you get to your office now, the head of finance, that finance department is a responsibility center. The head of finance is responsible for that center. It's an area of operations for which a manager is held responsible. Sales, head of sales is responsible. Responsibility center, defined as a department or organizational function whose performance is the direct responsibility of a specific manager. There are 4 types of responsibility center. There are 4 types of responsibility center. One is the cost center. Cost center. A cost center is a department within an organization. A department or a section or a function over which a designated individual has authority for expenditure. A cost center, a department, a section, a function, whereby a designated individual has been given the authority and the responsibility to incur expenditure. A cost center is a center for the accumulation of cost. A cost center, we only incur cost. Please note, a division cannot be a cost center. A division cannot be a cost center. Number two, profit center. A profit center is a business unit to generate revenue and incur cost. A business unit that has been given the authority to incur costs and generate revenue. Thereby, profit or loss is calculated from that center. A factory can be a profit center. At that factory, we manufacture and we make sales. We manufacture, we incur costs. We make sales, we generate revenue. At the end of the period, we can calculate our profits. Please note, a division can be a profit center. A division can be a profit center. Number three, investment center. An investment center is a business unit that has authority to incur costs, generate revenue, and in addition, can make investment decisions. In addition, the center can make investments in non-current assets. Designated manager is given the power to incur costs, to generate revenue, and to make investment decisions. At the end of the day, the profit generated can be related to the amount of investment. Please note, a division can be an investment center. Lastly, revenue center. A revenue center is a department that is only authorized to collect revenue. a revenue center, the manager is given the authority to collect revenue. In a revenue center, there is no measurement of cost and profit. Revenue center managers, we only need to have information relating to revenues to be collected. This notes, a division cannot be a revenue center. All right. Management accounting problems of divisionalized organization. What are the accounting problems? When a company has divisional structure, management accounting problems. One is intercompany transactions. If one division produces goods and services required by another division, Division A produces goods required by Division B, problem will arise in pricing. Problem will arise in pricing such transaction. If Division A is to sell goods to Division B, both divisions belong to the same company. At what price will Division A sell to Division B? That will create accounting problem. Number two, apportionment of joint costs. Establishment of separate divisions usually involve apportionment of common costs and assets. The management accountants will ensure that the apportionment is as equitable as possible. How to measure performance. Financial performance measures. We have return on investment. This can be used to measure performance of division. Also called return on capital employed. Your return on investment is the return or the profit generated from the resources used in running a division. The profit profits derived from the resources used in running a division, calculated as operating profit divided by capital employed. Your capital employed is the amount of investment you can use this to measure performance as, or you can calculate as shareholders fund plus long-term debt. Number 2 method, residual income method. Residual income is the excess of operating profits over return required by the suppliers of capital. Calculated as PBIT minus imputed interest. Where your imputed interest charge is calculated as capital employed multiplied by the cost of capital. We can use this to evaluate performance of division. And please note, if the residual income is positive, it means that that division is doing very well. If residual income is negative, it means that that division is doing poorly. We shall stop here. Any question? Any question? All right. We can't solve any question tonight. If there's no question, we shall be checking out of the classroom.